next item on our list, momentum indicator, helps you understand the speed of price movement of a stock by comparing prices over time. It helps you measure the rate at which the price of a specific stock rises or falls, and you can calculate it by comparing the most recent closing price of the stock with the previous closing price. The indicator generally appears as a single line below the price chart that oscillates as momentum changes, and when there's a divergence between price and the momentum indicator, that can signal a change in future prices. This indicator can also be used to analyze volumes. All in all, with this indicator, you'll gain a better understanding of the strength of price movements. Some of the common momentum indicators you might have heard of are RSI and Stochastic Oscillator. Let's study these a little bit more right now. RSI. The Relative Strength Index, or RSI, is a momentum indicator that you can use to measure the magnitude of recent price changes to evaluate whether the price of a stock or some other asset is in an overbought or oversold zone. The RSI is displayed as an oscillator. Technical analysts typically consider the RSI value above 70 as overbought zone and below 30 as oversold zone. We can understand this further with two examples. Observe from the chart that the RSI values were on a rise from the 15th of January 2019, indicating a growth in the share price. The upward trend continued and the RSI index rose to the value of 60.972 on the 21st of January. This value was considerably closer to the ideal upper bound value of 70. Combining with other indicators, you would come to the conclusion that this was the right time to sell this company's stock, and your decision would be confirmed at a later date when you see a massive fall in the RSI value, which reached a low of 30.004 on the 30th of January. Consider this chart here, too. The RSI value of this company on the 9th of January in 19 was 71.397, which was a red flag, indicating that the stock was being overbought in the market. Considering the advents in other indicators, you would most likely decide to sell the stock on the 21st of January. The RSI value on this date was 55.761, after which the value almost witnessed an exponential decrease, reaching a low of 29.06 on the 26th. Stochastic Oscillator. Now, a stochastic oscillator is a momentum indicator you can use to compare a specific closing price of an asset or a security to a range of its prices over a certain period of time. And you can reduce the sensitivity of the oscillator to the market movements by taking a moving average of the result or by adjusting that time period. You can use this indicator to generate overbought and oversold trading signals, utilizing a 0 to 100 bounded range of values. Stochastic oscillators are displayed as two lines, %K and %D. The main line, %K, compares the lowest low and the highest high of a given period to define a price range, then displays the last closing price as a percentage of this range. The second line, %D, is a moving average of %K. When the oscillator is either %D or %K and it falls below a specific level, let's say 20, it's generally a good time to buy. On the contrary, when the oscillator rises above a specific level, let's say 80, then you should consider selling. Consider this chart above too. Looking at this indicator, it's a good idea to sell on the 21st of January as both %D and %K were about to reach 80. After selling the stocks, you notice a good profit, and after that, the stock price started falling, which justified the selling of the stocks at just the right time. Take a look at another example. In the above chart, the oscillator, %D and %K, touched 80 in January and even rose above that level. At that point, it's a good decision for us to sell. You can witness that around the time of the 8th of January, when both the oscillator and the stock price started falling, you would justify our decision of selling stocks at the right time. Volatility indicators. This indicator shows how volatile the prices are, regardless of direction. Let's understand this in a bit more detail. When you start trading, you would realize that along with noticing when the market is trending or consolidating, you would also need to deal with volatility. Now, volatility can create big movement shifts in stocks' prices, which can make it difficult for you to trade properly. You can notice the high volatility when the market is trending, and low volatility occurs when the market is in a consolidation phase. Volatility indicators help you figure out the periods of high and low volatility in the market, and you can use these big swings to create trading opportunities for yourself. Generally, volatility indicators will provide you information about the range of buying and selling that takes place in the market, which you can then use to determine points when and where the market might change direction. One of the indicators you should keep in mind when analyzing the market is Bollinger Bands. A Bollinger Band is a technical analysis tool defined by a set of lines plotted 2 standard deviations, positively and negatively, away from a simple moving average, or SMA, of a security's price, but can be adjusted to your preferences. If the volatility increases in the market, these bands expand, and if the volatility decreases, the bands contract. We can understand this better by again taking the help of 2 examples. According to the Bollinger Bands graph depicted below, we see that it reflects reasons behind the decisions that were taken to buy and to sell the shares of the company at the times that they had been bought or sold. During the middle of December, the prices fell below the lower band, which signaled that the shares were being oversold and therefore triggered a buy signal. Similarly, towards the end of January, the prices rose above the upper band, and that triggered a sell in the market. Following these indications, a modest profit was booked by trading.